Forget Bitcoin or tech startups. One man retired at 40 with millions using the world's most boring investment. Wall Street wants you to think wealth is a gamble. But David turned $20,000 of debt into total freedom using a
From a janitor with $8 million to a secretary who turned 180 into $7 million. The secret isn't luck.
The man who retired at 40 with millions didn't own a single Bitcoin or a tech startup. He owned the world's most boring investment. This isn't a fairy tale. It's the story of one man who, armed with a strategy many dismiss as boring, transformed his financial future, exposing a truth about wealth building the industry often prefers to keep under wraps. And he almost lost it all to a fatal mistake that most investors never see coming. Our journey begins not on Wall Street, but in suburban America, where early retirement dreams often clash with financial realities. For our protagonist, David, the traditional path to wealth felt like a life sentence. He was drowning in $20,000 of credit card debt, working a job he despised, and the idea of retirement felt like a cruel joke. His secret wasn't a tech startup or inheritance, but a deep dive into what we'll call the boring method. Often misunderstood, these investment vehicles pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other securities. Imagine a financial potluck. Everyone contributes, creating a diverse investment feast impossible for individuals alone. This diversification is their superpower, spreading risk and offering broad market access. It's the sensible sedan that gets you to your destination faster and with far less drama. Many believe investing requires a fortune. David started small. The beauty of these funds, especially from major firms, is their accessibility. You don't need thousands. A few $100s or consistent monthly contributions can get you started. This low entry point democratizes investing. David understood consistency, not a massive lump sum, was the true engine of wealth accumulation. He started with what he could afford, adding to it faithfully month after month, year after year. How do these funds operate? A professional fund manager or team makes investment decisions for investors, researching and monitoring assets. Investing in one means buying shares in a portfolio whose value fluctuates with those assets. This professional management attracts many, removing the burden of individual stock picking. Many aim to match or slightly outperform the market long term, offering steady growth. It's a marathon, not a sprint, with managers as experienced coaches. Your money's growth primarily comes from three sources: dividends, capital gains distributions, and capital gains from selling shares. Dividends are company profit payments passed to you. Capital gains distributions occur when the fund sells securities for profit. Selling shares for more than you paid yields a capital gain. David understood reinvesting these distributions, using the cash to buy more shares, accelerating wealth growth through compounding. This small decision is a cornerstone of long-term investing, turning modest returns into substantial fortunes. No financial instrument is without quirks, and these funds have fees. These aren't always obvious, often in the fine print. Common fees include expense ratios, an annual management tax, sales loads, commissions to brokers, transaction fees, and 12b-1 fees, a marketing tax.
David scrutinized these, understanding even small percentages erode returns. His strategy involved picking funds with low expense ratios and no loads, often index funds or passively managed ETFs. This detail was a major differentiator in his journey. David's strategy was simple: set it and forget it, with periodic reviews. He automated investments, transferring money into his chosen funds every payday. This dollar-cost averaging meant buying more shares when prices were low, smoothing his average purchase price. He rebalanced his portfolio annually, maintaining asset allocation. This hands-off method freed him from market timing's emotional roller coaster, allowing him to focus on life while his money worked. It proved that sometimes the least intervention is the most effective strategy. David's most profound secret wasn't the funds themselves, but the psychology of money. The financial world often preys on fear and greed, leading to impulsive decisions. David cultivated patience and long-term vision. He saw market downturns as buying opportunities, not reasons to panic. He resisted get-rich-quick schemes, recognizing them as distractions. His financial freedom was a triumph of emotional discipline over market noise. He trusted the process, believing in long-term economic growth, viewing setbacks as blips. This psychological fortitude was his most valuable asset, allowing him to stay the course. No investment is without risk, and these funds are no exception. While diversification mitigates some dangers, they are subject to market risk. Value can go down, and returns aren't guaranteed. Interest rate, inflation, and management risks also exist. David understood these, mitigating them by carefully selecting funds with proven track records and clear strategies. He diversified across different fund types and asset classes to reduce overall exposure. He knew calculated, intelligently managed risk was the only path to significant returns. David's journey wasn't unique. Millions built wealth through these funds, often without fanfare or celebrity. Take Ronald Reed, a gas station attendant and janitor from Vermont. When he passed away, he left behind an $8 million fortune. His secret? Frugal living and consistent investment in blue-chip stocks, many of which were held within mutual funds. He wasn't a stock market guru, he was a patient accumulator. Then there's Grace Groner, a secretary who in 1935 invested a mere $180 in 3 shares of Abbott Laboratories. By the time she passed, her investment, thanks to reinvested dividends and stock splits, was worth over $7 million. These aren't isolated incidents, they are powerful testaments to the long-term, disciplined investing in accessible vehicles like mutual funds. David drew immense inspiration from these quiet millionaires, understanding that extraordinary wealth often stems from ordinary actions consistently applied over decades. It's a stark contrast to the flashy, high-risk ventures often promoted today, proving that sometimes the tortoise truly does win the race. David learned from common pitfalls, the kind that derail even the most well-intentioned investors. The biggest mistake, the one that almost ruined him, was the siren song of timing the market. The urge to panic and sell during downturns, or to get greedy and buy high during booms, is a classic error that has destroyed countless fortunes. David confessed to almost succumbing to this, nearly selling everything during the 2008 financial crisis, a decision that would have cost him millions. Another insidious mistake is ignoring fees. As we discussed, high expense ratios and sales loads are silent assassins, eroding significant portions of returns over decades. Many investors overlook these seemingly small percentages, unaware of the long-term damage. Lack of diversification is another dangerous trap. Putting all your eggs in one basket, even if that basket is a mutual fund, can be risky if that fund is highly concentrated in a single sector or asset class. David saw friends lose substantial sums by betting too heavily on a single industry. Finally, failing to reinvest dividends and capital gains means missing out on the exponential power of compounding, essentially leaving money on the table. David avoided these mistakes by sticking to his long-term plan, focusing on low-cost, broadly diversified funds, and allowing the relentless magic of compounding to do its work, even when his gut screamed.
These funds offer substantial long-term profit potential, not overnight riches. Historically, diversified stock market funds have delivered 8 to 10% average annual returns over decades. Inflation adjusted, that's closer to 7%. This consistent growth, combined with compounding, can turn modest savings into significant wealth. For David, early and systematic investing meant his portfolio by age 40 generated passive income covering his living expenses. This was about financial independence, the freedom to choose how he spent his time, not being dictated by a paycheck. It was the ultimate profit: time and freedom. So, what was the mutual fund's secret that made him financially free at 40? It wasn't a secret, but a combination of accessible tools, disciplined habits, and a profound understanding of wealth accumulation. Consistent, low-cost investment in diversified mutual funds, coupled with reinvesting returns, built his bridge to financial freedom. David's story is about empowerment, taking control of your financial destiny with readily available tools. It's a reminder that powerful secrets are often hidden in plain sight, waiting for those with patience and foresight. The question isn't if you can achieve financial freedom, but when you will start your journey.